So last week, I did a video talking about my M1 Finance dividend portfolio and how I borrowed $25,000 to invest back into my portfolio. And on that video, I was getting a lot of questions about how this worked and people looking for me to explain this in more detail. So in this video today, we're going to be talking about this feature of M1 Finance and in general, something called a portfolio line of credit and how this can enable you to get access to essentially free money. Now, before we get into this, guys, I just have to go ahead and say that this is not any kind of financial advice, and I am not a financial advisor. Also, this is what I have chosen to do with my own investment portfolio, and I'm not recommending it as a strategy for anyone else to follow. I am simply making you aware of this tool that you may decide to use when building your wealth. And while this is technically free money, there are risks involved with this strategy, which we will discuss later on in this video. So first of all, for those who are not familiar, M1 Finance is a commission-free stockbroker out there that is popular for long-term and dividend investing, and that is where I have built my dividend portfolio. Now, one of the benefits to M1 Finance is that if you have at least $10,000 invested with them, you can take advantage of a feature known as M1 Borrow, which is exactly what I have done within my portfolio. Now, essentially, M1 Borrow is something called a portfolio line of credit, and this allows you to borrow money against the securities held within your account. And if that doesn't make sense right now, guys, don't worry, we're going to explain this in much more detail. And of course, guys, I want to be as open and transparent as possible here. I am affiliated with M1 Finance, so if you sign up with my link down in the description below, I may earn a small commission in the process, but that affiliate relationship in no way influences my thoughts and feelings on this brokerage platform. Now, when you borrow money, there are two primary types of loans out there. The first is a secured loan, and the second is an unsecured loan. And I want to go ahead and cover the differences between those two now. An unsecured loan is one where there is no asset backing the loan. A few examples of this are medical debt or a credit card debt, because there is essentially no collateral in place in case you do not pay back the debt. For example, with a credit card, if you rack up a bunch of credit card debt, spending money on day-to-day purchases, and then you don't pay the credit card company back, they can't exactly seize all of those items that you purchased because maybe you used them up already, or maybe you simply spent that money on a vacation. There is no asset or collateral backing that unsecured loan. And that is why interest rates on credit cards are sky high, in some cases 20% or more, because the bank is taking a massive risk by offering you that unsecured line of credit. Now, on the other hand, with a secured loan, there is some kind of asset backing that loan, which essentially means if you don't pay them back, they take ownership of that asset to recuperate their losses. And the two most common types of secured loans out there are number one, auto loans, and number two, your mortgage. If you don't pay your mortgage for a set period of time, it will go into foreclosure, you will lose your home, and the bank will sell the house to get the money back from the mortgage. And the same thing with an auto loan. If you don't make your car payments, after a set period of time, your vehicle will be repossessed and sold at a bank auction. Now, a portfolio line of credit, which is exactly what M1 Finance offers with M1 Borrow, and other brokerages offer this as well, is a type of secured loan. However, instead of having this loan backed by an asset such as a house or a car, it is backed by the securities held within your account, or in layman's terms, the stocks and ETFs that you have purchased within your brokerage account. Now, it's a little bit more complicated than this, and we're going to get into it later, but essentially, if you tried to stiff your broker and you didn't pay back that loan, they would have the right to sell those stocks and ETFs to get their money back out of it, and this makes this type of loan extremely low risk for the person offering this loan. So for M1 Finance in this case, or other brokerages offering a portfolio line of credit, the risk is very low for them, and as a result, interest rates are low as well. So now, let's talk about the interest rates associated with these different types of secured and unsecured loans. First of all, for credit cards, we talked about this, you could pay anywhere from 17 to 25% or more for an interest rate on a credit card because it is unsecured and very high risk for the financial institution. Auto loans and mortgages are lower because they are secured and there is an asset backing that loan. Now, a portfolio line of credit is very low risk because it's a highly liquid asset, meaning your brokerage could easily sell your shares and recoup the money if such a situation arose. So as a result, these rates for borrowing against your portfolio are even lower in most cases than with a mortgage or an auto loan. So with M1 Borrow, assuming you have at least $10,000 within your M1 Finance account, you can borrow against those securities with a portfolio line of credit at an interest rate of 3.5%. However, where things get more interesting here is if you are an M1 Plus subscriber, which is an annual fee of $125 per year. It comes with a number of different perks, but one of the huge ones is that they take 1.5% off of the M1 Borrow rate. So all of a sudden, you're able to borrow money at a 2% interest rate against the securities held within your portfolio. Now, I know what you're saying to yourself right now, probably something along the lines of, how is a 2% loan free money? Well, at the end of the day, guys, there is no such thing as a free lunch, and nobody is going to simply hand you free money with a 0% interest rate. However, if you are able to earn a return that exceeds what you are paying on a given loan, that is how you can essentially earn free money. But again, I just want to restate this, guys. This is not 100% risk-free, and we'll cover what those risks are later on in the video. So here's what I decided to do with my M1 Finance portfolio. I took out a portfolio line of credit through M1 Borrow in the amount of $25,000 at an interest rate of just 2% since I am an M1 Plus subscriber. And this essentially means I am borrowing $25,000 and paying $500 per year in interest in order to borrow that money. Now, you can do many different things with that money that you borrow. You could have it sent to your checking account and use it for medical expenses or paying off higher interest debt. However, what I decided to do was to take that $25,000 and reinvest it back into my dividend portfolio. Now, my portfolio holds blue chip dividend paying stocks, many of which are dividend aristocrats, which means they have been paying and growing that dividend for 25 consecutive years or more. And in total, the yield of my portfolio is 3.185%. So in a nutshell, that $25,000 that I have borrowed from M1 Finance will earn a return of 3.185% per year based on the dividend yield of my portfolio, assuming that dividend yield does not change. And by investing in blue chip stocks and mostly dividend aristocrats, I have mitigated that risk of having a massive change in that dividend yield since I am diversified across 15 different dividend paying stocks. So if you take that $25,000 borrowed and I earn a yield of 3.185% in dividends, that adds up to $796.25 per year. And as mentioned earlier, that loan is going to cost me $500 per year in interest based on that 2% rate. So essentially, when you take my potential earnings from dividends and subtract out the interest paid for M1 Borrow, that leaves me with a net profit of $296.25. However, that is just one way which you are able to be paid from dividend stocks. Where things get interesting is that you can also earn money from something called asset appreciation, or buying something at a certain price and selling it for a higher price down the road. Now, the average return from the stock market over the last 100 years or so is around 10% per year over the long run. It's important to remember you don't often earn a 10% return year after year because there are hills and valleys referred to as bull markets and bear markets. But if you invest over the long haul, you can expect a return of around 10%. So if you instead use that 10% figure instead, which includes dividends being reinvested, if you earn 10% and you're paying 2% to borrow that money invested, your net return here is 8%. But again, just keep in mind, it is not something you should expect to see year after year. That is the long-term annualized return. So on $25,000, which is the amount I borrowed, that is a return of $2,500, assuming I earn 10%. When you subtract out the $500 paid in interest, that is a net profit of $2,000 per year using money that is not mine. And so essentially, this could enable me to earn $2,000 per year in free money. Now that being said, guys, it is not 100% risk-free, and it's certainly not guaranteed because the performance of the stock market is not a straight line. So that being said, here are the risks associated with investing borrowed money through a portfolio line of credit. First of all, the rate at which you are borrowing that money can and will change. Right now, through M1 Borrow, you can get it for 3.5% or 2% if you are an M1 Plus user. However, that interest rate is based on the federal funds rate, which is essentially the rate at which the federal government loans money to banks. Now that rate is extremely low right now based on this global pandemic. Essentially, the Federal Reserve dropped rates as much as possible to a range of 0% to 0.25%. If the Federal Reserve decided to increase that rate, well then all of a sudden the rate at which you are borrowing money is going to go up as well. So if the Federal Reserve increases rates, which is not likely to happen for some period of time, understand that it would make the rate at which you are borrowing money go up as well, making this a less lucrative opportunity. The second risk to understand here is that the value of the underlying asset that you purchase can and will change. The price of a given stock or ETF changes every couple of seconds based on what people are willing to pay for it and what people are willing to sell it for. And when you invest borrowed money into an asset that fluctuates in value, there is the potential risk here of a magnified loss. So just for an example of this, guys, let's say you have $10,000 invested and you borrow 35% of that value, which is how much you are allowed to borrow using M1 Finance. That means you have $10,000 of your own money and $3,500 of borrowed money, giving you a total of $13,500. Now, let's say you invested at the worst possible time right before there was a bear market, and then the market dropped 33%, which is the average decline during a bear market. Well, your $13,500 investment would now be worth around $8,910, which essentially means you lost $4,590 of value within your portfolio. Now, if you instead invested just $10,000 and did not borrow money to invest with, and you experienced that same 33% decline, your portfolio would now be worth around $6,600. And so that means you would have experienced a loss of just $3,400 versus $4,590 by using borrowed money. So when you invest with borrowed money, you are magnifying your potential losses because you have more equity or skin in the game. And third of all, guys, this magnified loss could lead to something called a margin call, which is essentially when your broker requires you to deposit more money to invest, or they're going to sell a portion of your securities or stocks and ETFs in order to cover a portion of the loan. So let's say, for example, you have $10,000 invested of your own money and $3,500 of borrowed money. Well, all of a sudden, if your portfolio tanked and fell to a value of $4,000, well, all of a sudden your broker is going to get concerned because if the value of your stocks and ETFs falls below how much money they have loaned you, they won't be able to recoup that loss. And so an event like this, after a substantial drop in your portfolio's value, could result in this margin call where you have to deposit more money or they are going to sell some of your shares. So in order to avoid this margin call, you have to make sure the equity in your portfolio always remains higher than the amount of money that you have borrowed. So in my case, if my portfolio value fell to around $25,000, that would likely trigger a margin call. However, you can mitigate this risk by investing in durable, time-tested companies such as blue chip stocks, which is what I have chosen to do with my portfolio. It would not be wise to invest borrowed money in speculative assets that experience drastic price fluctuations, because that would make it more likely that you would experience a maintenance call. So there you have it, guys. That is essentially how you can use a portfolio line of credit and potentially get free money. As mentioned, there are risks associated with this, and I'm certainly not recommending that you follow this as a strategy. This is simply what I have chosen to do with my own portfolio. If you guys want to learn more about M1 Borrow, I'm going to link up to an article I did over on my blog that goes into more detail. And of course, if you decide you want to support this channel and sign up for M1 Finance, there is a link down below as well. But thanks so much for watching, guys. I hope you enjoyed this video. Subscribe if you haven't already, and I will see you in the next one.